What if I told you that Africa's future may depend on a quiet financial battle between China and the International Monetary Fund? One side offers fast money with fewer questions. The other offers strict rules and economic reforms. Both claim to help Africa. But which one really benefits the continent? Across Africa, governments are building roads, railways, ports, power plants, and cities at a pace never seen before. But none of this is cheap. To finance development, African countries borrow billions of dollars, and two of the biggest lenders are China and the IMF. On the surface, both offer loans, but their approaches are completely different. Before we break it down, subscribe to the channel and turn on notifications, because understanding how money shapes nations is key to understanding global power. China's model is simple and fast. African leaders approach Chinese banks and state companies with a project proposal. China finances construction, often using Chinese companies and workers, and the project gets built quickly. There are fewer political conditions, fewer public negotiations, and less involvement in domestic policy. This makes Chinese loans extremely attractive. If a country needs a railway, China can build it. If a nation needs a port, China can fund it. If electricity is needed, China can finance a power plant. For many African countries, this is the fastest path to infrastructure. The IMF, on the other hand, is different. IMF loans usually come with conditions. Governments must reduce spending, reform state companies, fight corruption, and sometimes cut subsidies. These policies are designed to stabilize economies and prevent financial crises. Supporters say the IMF helps countries avoid economic collapse. Critics say the reforms can hurt ordinary people, raising fuel prices, reducing social programs, and slowing growth. So which is better? China's loans often build visible projects. Trains run, roads open, power plants turn on. These projects can boost trade, create jobs, and attract investment. Infrastructure is the backbone of development, and China focuses heavily on it. But Chinese loans are not free money. They must be repaid. Some projects generate enough revenue, others do not. If a project fails to make money, governments still owe the debt. This raises concerns about debt sustainability. The IMF focuses more on financial stability. Instead of building roads, it tries to fix budgets, control inflation, and stabilize currencies. This can prevent economic crises, but it often slows government spending on big projects. In simple terms, China builds things, the IMF fixes financial systems. African leaders often prefer China because voters can see roads and trains. Infrastructure is politically popular. IMF reforms are invisible and sometimes unpopular. But the story is more complex. Some critics say Chinese loans can increase dependency on China. Others argue the IMF can increase dependency on Western financial systems. Both sides involve power and influence. China rarely vmešaje in domestic politics. The IMF sometimes pushes political reforms, transparency measures, and governance changes. Some governments prefer China's non-interference approach. But non-interference also means less oversight. Projects may lack transparency, leading to corruption risks. The IMF demands transparency and reforms, but that can be politically difficult. African economists often say the ideal solution is not choosing China or the IMF, but balancing both. China can fund infrastructure. The IMF can stabilize finances. Countries like Ethiopia, Kenya, and Ghana have used both Chinese loans and IMF programs at different times. The challenge is managing debt wisely and ensuring projects generate economic growth. One key difference is interest rates and repayment terms. Chinese loans vary widely. Some are concessional with low interest, others are commercial. IMF loans are generally lower interest but come with strict conditions. China often negotiates directly with governments. The IMF works through structured programs with international oversight. Another difference is speed. China can approve and build projects quickly. IMF programs take time, negotiations, and policy changes. For developing nations, speed matters. If roads and electricity are missing, businesses cannot grow. Infrastructure delays development. That is why many African countries turn to China first. But infrastructure alone is not enough. Without strong institutions, good governance, and financial stability, economies can struggle. That is where IMF reforms play a role. So which is better for Africa? There is no simple answer. China's loans are better for rapid development and infrastructure. The IMF's loans are better for financial stability and economic reform. The real risk is not borrowing. The real risk is borrowing without a plan. If projects generate growth, loans can transform a nation. If projects fail, debt becomes a burden. Africa's future will likely involve both China and the IMF. The continent is not choosing sides. It is choosing development. As global competition increases, Africa has more options than ever. That gives African nations bargaining power. They can negotiate better terms, demand technology transfer, and shape their own development path. The financial battle between China and the IMF is not just about money. It is about influence, models of development, and who sets the rules of global growth. And Africa is no longer just a passive player. It is becoming a strategic partner, a market, and a key region in the future global economy. The question is not whether Africa should borrow from China or the IMF. The question is how Africa can use both wisely to build a sustainable future. If you want more unbiased stories about global economics, power shifts, and development, like the video, subscribe, and turn on notifications. Because the next global financial battle is already happening.